Okay, great. Well, I'm just going to start us off with a very quick introduction, and then I'm going to hand over to Riley and Pat, who will be kind of having a discussion during this time. If you don't know me, my name is Alice Bosley. I am one of the co-founders and the executive director of 51 Labs. I am especially excited for this event. I am excited for all of the events we hold, but this event in particular, I think is extremely important for any entrepreneur in Iraq who is interested in getting investment. So if you are hoping to grow your business, one of the major things you need to know about is what are the different types of investment that might be open to me. Angel investment is one. We had a webinar a month ago or 2 months ago on that topic. Now we are focusing on something called venture capital, which currently is not happening very much in Iraq, but I can assure you that over the next couple of years, this will really start happening. Startups across the country are already getting more and more investment from different sources. And so this is something that you all as entrepreneurs, or maybe you are out there as an aspiring entrepreneur or an aspiring investor, this is a really exciting thing for you to learn about. This series is part of something called 51 Invest, which is a new initiative that 51 Labs has started to help with a number of things. First, to strengthen the investment ecosystem across Iraq by supporting both investors and entrepreneurs to learn more about what it's like to invest in startups, or if you're a startup, to learn more about investment, to get more ready for investment as startups, and then also to make more connections between investors and startups, hopefully in a way that will create more investment opportunities and more capital going towards startups and early stage businesses in Iraq. So we're really excited. This is part of a public speaker series we are hosting. This is going live on Facebook to get a broader audience. And then we are also pre-recording this session and adding subtitles in both Kurdish and Arabic so we can share it more broadly, even with people who do not speak English. So with us today, we have a speaker named Riley Rogers. I had the pleasure of meeting Riley maybe 1.5 years ago or 2 years before COVID. So it was basically a million years ago. And I think if I remember correctly, I met him in Jordan, where he actually gave a presentation on venture capital investing for a group of people who were hoping to become investors. And I was really impressed with how clear he was about what VC was and the way his own firm called Valley of Ventures operates. Riley's also very interesting because his firm works with investors across the Middle East to invest in some of the best startups in the United States. So he has an amazing view of both all of the actors in the Middle East that are investing in startups, but then also some of the most modern and kind of high-tech startups in the world, which are coming out of the Silicon Valley. And so he kind of sees both worlds. He has a foot in the Middle East and a foot in San Francisco, where he is now. And so I think he is a perfect person to share more information about venture capital investing and the opportunities of VC, both in the Middle East and around the world, because he has seen kind of so many different perspectives of it. So that is enough talking from me. I'm sure you're all really excited to hear from Riley. Just one more thing is to run our conversation with Riley and kind of interview him and ask some questions. We have Pat Klein, who is the investment advisor with 51 Labs. And we're really happy also to have Pat here to help us run this conversation with Riley. So Pat, thank you for being here to talk with Riley. Riley, thank you so much for waking up at 8 a.m. to join us for this really important conversation. And we're all really looking forward to it. So Riley, I will hand over to you because you have some slides first, and then we can get into some questions afterwards.
Perfect. Thank you so much. Really appreciate the introduction, Alice. I have to reiterate, I think when we met in Jordan, I heard more about 51 Labs and had the chance to meet a few of the startups there. I still remember to this day thinking about how important grit is and resilience and entrepreneurship, and the founders that I met that came through 51 Labs showed grit and resilience to the nth degree. So incredibly impressed at what you and the team have done. And I think for everyone on the call, some of these topics may be foreign, and hopefully we can unpack that a bit. But at the same time, everyone's journey is quite unique. And I think for all of the founders here and have gone through 51 Labs, I'm incredibly impressed. And so at least one fan from 9,000 miles away cheering you on, and hopefully some of this information helps you get to where you want to go. So as mentioned, I threw together a couple slides, wanted to keep more of this discussion based, but I thought these could be helpful just to set some of the framework about what is venture, what is some of the history, how do funds work, and then I'm excited to jump into the conversation with Pat. So I'll go ahead and share my screen, and let me just hit present right here and make sure this is working. I get a thumbs up if you guys can see these. Perfect, excellent. So first, just wanted to start here because as we think about venture, it's really important to set the context that it's just one source of capital for startups. It sounds like last month you spoke mostly about angels, another phenomenal source. 51 Labs in and of itself is really more of an accelerator and early incubator of companies. And then there are many other sources of capital early on. So we have friends and family, we have customers that prepay, we have crowdfunding, which has become quite popular in the US. And then there are many companies that decide to eschew the route of raising capital and bootstrap their business. And there's nothing wrong with it. And so today, we're really going to focus on venture, and one analogy to use is to think of venture as rocket fuel. So just because it's one source of fuel, it doesn't mean it's the right fuel for everyone or every business. And we'll go into the reasons why it's rocket fuel and how that actually works. But it's really important to start here and remember that this is just one fundraising source. It's not right or wrong. It can be a fit for some businesses, and for others, it might not be. So let's just focus on that of what it is not, because this is a really easy place to start. So we'll go into how funds work in a couple slides, but you really need to be going after a very large market opportunity. I'll use the example, like you could run a phenomenal business, but if it doesn't have the opportunity to be a several hundred million or a multi-billion-dollar business, it can be really tough to make the math work for a venture fund to invest. And so you really need to be going after a very large market opportunity. And that's almost the first place where people start to decide whether or not it might be a fit for their business. The second thing, it's not, like we talked about, it's not the only way to fund your business. Even companies we invest in as a venture fund frequently have raised from angel investors, have gone through accelerators, have used friends and family financing. And so I don't want people to think that this is the only source for the businesses, even if it is a fit for them. And it's also not a substitute for debt financing. Sometimes people get hung up on this and think the only difference is they pay it back versus they don't pay it back. There are some really fundamental differences between equity investing and debt financing. So we want to make sure we don't confuse the two. And like I mentioned before, it's not better or worse than another. It's just one of them. And so sometimes I have a hard time with people who get overexcited about venture as one source of financing, when it really makes sense to look at the whole pool of opportunities and make sure they find the right one for their business. So this was one of the questions Alice and Pat had, which is what is the history? And I really love this story of just starting here to show you back, how far this goes. So the real history of venture goes back several hundred years. The concept of carried interest, which is how people get paid, how general partners get paid in venture, starts actually with the shipping days. So what would happen is someone would go off on a very risky voyage, and they would sail their ship across the sea, and they would go and find products, and they would go and find rare exotic items from a new part of the world, and they would bring it back to sell to merchants. The people who financed those ships would then take 20% of the profits. And so the term carried interest and the idea of how us as investors get paid really goes back several hundred years ago. And these are some of the earliest examples of venture, really looking at how we get paid and how people are incentivized to provide funding to these companies. And then there's a much more modern history and current day of venture, which goes back to the Bay Area in Silicon Valley, where I am now. And it has to do with an individual named George Dorio, who set up a venture fund back in the 1950s. And you can see here one of his first investments where he invested $70,000 in a company, which then turned into a $38 million position. And so we really look for outliers. This is the first example of an outlier, someone making a 500x return on their investment. Again, that's what the goal is of venture. It's not the same as for other folks. But really this fundamental story, the story of George Dorio and Fairchild Semiconductor, turned into the beginnings of the venture ecosystem. And I think what's important to look here is, we might feel that the ecosystem in Iraq is much further behind, but it really did take 70 years for it to grow in the US and started here in the Bay Area. And now it's something that's all across the globe. And so when we look at how fast these ecosystems can grow, I think that's one point of encouragement for everyone, which is it's not as if this ecosystem was here in the 1700s or 1800s. These firms, some of the biggest names like Sequoia Capital and Kleiner Perkins, were started in the 60s and 70s. And so obviously they have a fair bit amount of history, but it doesn't mean that those firms can't be started in your backyard today. So if we look at just the offspring of Fairchild Semiconductor, you can see what impact this has. So when we talk about ecosystems and we talk about the density of those ecosystems, this is just one idea. So we had one individual, George Dorio, started one firm, Fairchild Semiconductor, ARDC. ARDC created Fairchild Semiconductor, and then that one company really created the birthplace of Silicon Valley as we know it today. And so that's really encouraging to you, because I would look in the Middle East and point to examples like Kareem as early examples of this. Because what ends up happening is you have one very big success story, which spawns dozens of companies. You're already seeing that in UAE and other parts of the Middle East. And all of a sudden, it's just normal that there's an ecosystem. And so that one big, successful exit, that one successful firm can make enormous strides to lay the foundation of that ecosystem. And you can see that's how it worked here in the Bay Area. So where are we today? The question I get asked is venture important and does it matter? And at least focusing on the US as one data point, I can answer resoundingly it does. If we look at some of the basic statistics around venture-backed companies that ultimately went public, not only are there phenomenal examples like Tesla and Apple and Starbucks and others, it really just makes an enormous impact on the economy. It accounts for almost half of all of the market cap of companies that are public in the US. It accounts for a large number of the jobs. It accounts for a large number of the R&D dollars. And so when we look at a successful picture of a venture ecosystem like in the US, we can see that it really has a big impact. And so I think this data is important for you to use as you go back and talk to NGOs and government officials and people to show why venture and startups are important. The data is right here. And obviously there are nascent examples across the Middle East, but it's really encouraging to see that a small number of companies can have this outsized impact, and it really can impact the whole economy and the whole country. So it's something that for me is really exciting to be a part of. So next we'll digest venture a little bit and be a little bit more specific. So there's a few different ways venture funds are divided. The first one is by stage. So we as Valia, we're a very early stage investor. We focus on pre-seed and seed investing. There are other investors that focus on Series A and Series B investing. And then there are investors that focus on Series B growth, pre-IPO rounds. The next way investors are divided up is by location. There are some firms that are only in the US, others that are international, some that are even more focused. Instead of being US focused, they're just investing in New York or in San Francisco. And you see the same thing in the Middle East. Some firms are just focused on Lebanon, for example, or just focused on the UAE. The next way we break funds up is by sector. So there are generalist funds that invest across sector. They'll invest in consumer companies, hardware, B2B, fintech, edtech, and really they want to find great entrepreneurs and invest across category. The next type is specialist firms. So some firms only want to invest in fintech, or only want to invest in hardware, or only want to invest in enterprise software focused startups. And so those firms obviously have a much more narrow mandate of what they're looking for and what they'll invest in. The next piece is thematic funds. So they might invest in an area like the future of finance. And so that might have both consumer and B2B implications, but they have a more narrow theme, which is they don't invest in everything. They don't invest in one thing, but they invest in a number of things. And so that's the third way people are broken up. And the last is by platform. So some funds have built their firm to focus on supporting entrepreneurs in a particular way, whether that's with fundraising, whether that's with hiring, product development, and they have some special expertise, which they like to share with their portfolio. So the simple way to break this up is within venture, there are sector-focused firms, there are sector-agnostic firms, and then there are stage-focused firms and stage-agnostic firms. And so at least in the US, you'll find dozens of examples of each of these. But for entrepreneurs, it's important to know who you're talking to. And if you're, for example, a very focused entrepreneur in ed tech, but you're going and chatting with someone who only invests in B2B, you should know right away that they might not end up investing in your business. So it's really important for you as an entrepreneur to start here and make sure you're talking to a fund that has relevant interests to the type of business you're building. So last couple slides here, I wanted to just show, a quick snapshot of the existing MENA ecosystem. This is a couple of years old now, but you can see in each country, there really is the ecosystem being created, from accelerators to venture funds to government-related support. And I think what's really exciting here is you start to look at the size of these ecosystems, compare it to where you might be in Iraq. You don't need 50 years to create this. You need several years of people who are really focused on this and investing their time and energy and money. And we talk about these ecosystems now like they've been around forever, but venture investing in the Middle East has not been there forever. It's quite a new concept, but something that's showing a really big impact, and something that now we're starting to see across regions and across many countries in the MENA region. Sorry, this slide did not come out well at all. My apologies, but this is just a quick snapshot of some of the funds. And so if we just focus on the venture funds, so this was a bit more broad about different resources in each country. If we just focus on the venture funds, now there's over 100 venture funds across the Middle East. It's really exciting because a big way to grow an ecosystem is to bring in more capital. A big way to bring in more capital is to have more venture funds. And so if we look at a parallel in the US, there are thousands of venture funds. And so if we think about building a successful ecosystem in the Middle East and in Iraq, it's really about bringing in more funds and growing the total number of investors. So very last section here, which I think is important to just understand a little bit of how funds work. And then excited to jump into questions with Pat. So there's a couple different very complicated words here, which I'll try to simplify. So the first place to start with venture capital funding is with limited partners. Limited partners is a fancy way to say investors who invest in venture capital funds. A general partner on the left side here is a fancy word to explain who runs a fund. So think limited partner, the money behind a fund, general partner, the person who manages that fund. One fund will end up investing in dozens of companies. And so they'll raise from limited partners, they'll go get large banks, government institutions, sovereign wealth funds, family offices, university endowments. All of them will put capital together into a fund, which the general partner manages, and they'll invest in dozens of companies. There's two ways we get paid. So first, we talked about the carried interest example back in the shipping terms. We do get 20% of profits once we return the fund. The other way we get paid is we get a management fee. And so if we raise a $100 million fund, we get 2% of those dollars every year to cover our own expenses and make sure that we can pay for our staff, travel, marketing, events, et cetera, legal. And those are the very simple two ways people get paid in venture. The reason why that's important, and this is the last slide I'll have for you guys, is it shows how important the outliers become in a venture business. And it really just comes down to math. And so the way this math works out is we'll assume we have a $50 million fund. If we look even in the Middle East, someone like Abeco Capital was managing a $50 million fund as an analog. For them to be successful, they need to deliver a 3x return on that. So investors gave them $50 million. They need to give investors back $150 million to create a $100 million profit for that fund. Based off that $100 million profit, the general partners, who we talked about as the fund managers, get a 20% carry, so 20% of those profits. And in this case, that means $20 million. So 20% of 100, pretty simple math. So after they take their profit, the rest goes back to limited partners, and those are the people who continue to invest in funds over time. The way this math works out to deliver a $150 million fund return means you have to invest in one really big winner. And you see here the size of that winner to create a $1.5 billion outcome and $150 million return. So if that venture fund invests in a company and they own 10% of that business, and that business sells for $1.5 billion, then the fund gets this $150 million return. Imagine now if that exit was only $750 million, so half. In that case, they would have barely returned the fund. They would have returned $75 million. And so the difference between a very large exit, think a multi-billion-dollar exit, and still a very large exit at $700 million is really the difference between a fund that is actually performing well versus a fund that isn't performing well at all. And so when you think about venture and when you think about the size of the companies that we need to invest in and the outcomes of those, you really need to start with this math. Now, if the fund is smaller, for example, if the fund is $10 million, obviously we might not need the $1.5 billion return. But at the same time, we still really do need a large outcome to be able to generate carry and generate a successful fund. So like I said, those are just a couple slides I wanted to share on how venture funds work, a bit of the history, some slides on market map, but hopefully that's helpful context for everyone.
Thank you for that. That was great. I think that was a really amazing introduction to the concept. And you know, we did speak about angel investing, so this is a good explanation of the continuation. So appreciate that. I'm going to ask you to do a couple things in this next question and sort of, as you said, unpack some of the terms and explain sort of, and give you a chance to talk a little bit more about Valia. Yeah. So a way I thought about doing that is basically, if you could talk us through a deal, just a hypothetical deal. So you know, you found a company you're interested in. If you could explain the deal process and also talk a little bit about what seed means, and then talk a little bit more about how you're different from an angel investor, for instance.
Yeah, for sure. So just want to make sure I have this. So there's deal process, how we're different than an angel, and sorry, I missed the very first part of that.
And just what it means to be seed. So, you know, you mentioned Series A. So for those people who are not familiar with the process of VC, sort of, you know, you're at the beginning, if you could explain that.
For sure. So I'll start with the angel continuation onto venture funds, because that I think will help address the seed definition and terminology. And so the really first place most companies start with funding is friends and family. And so they're going to, you know, people who are close to them and people who trust them, maybe former colleagues. And what they're doing is getting that first bucket of capital. For some people who are very fortunate, that's a much bigger pool of capital and bucket of capital. Other people, it might be non-existent. And so first step, friends and family in almost every scenario. The second step is frequently angel investors. And so angel investors are people who might invest as little as $10,000 per individual. Some angel investors invest much larger amounts, $500,000, $1 million. And they're the ones who are providing that first six-figure check, maybe even up to a seven-figure check. So think about it in terms of dollars. Let's say the first $20,000, $50,000 is coming from friends and family. The next $250,000, $500,000 is coming from angel investors. That's when we're going to move on to this next stage of pre-seed investing, seed investing, and venture funds. And so when an angel investor ends up investing, the challenge with that angel investor is they can't necessarily continue to write significantly larger checks. The way to get access to the $1 million investment or the $2 million investment is frequently to go to a venture fund. And so in some cases, a startup will skip that angel investing step and they'll go straight from friends and family or straight from an idea to a venture fund. But in many scenarios, it goes from friends and family to angel investor, and then it moves on to a venture fund. And so the way to think about seed investing is a tough definition because it's a bit of a continuum. Sometimes people refer to seed investing as an idea. There are a couple of great founders with an idea. Someone writes what's called a seed check, and there's very little traction. In other scenarios, a seed investment might be with a company that's doing $1 million a year in revenue. And so the way to think about the seed investment is more of a continuum. It might be in multiple steps. Sometimes there's what's called a pre-seed investment, which might only be $500,000. And then you might move on to a seed investment, which could be a couple $1,000,000. And so again, the angel investor is normally before the seed investment. The seed investment will come next from the venture fund, and then you'll move on to Series A, Series B, et cetera. The Series A, Series B is usually much easier to define than seed because, like I said, sometimes those seed investments are done with basically nothing that the company has built, and other times the company is much further along. The deal process for us as a firm, as seed investors, is quite similar to many other venture funds. And so there's two ways we end up seeing opportunities. One is inbound. So someone like Alice, who works with entrepreneurs, says, hey, there's this amazing founder, you should talk to them. She makes an introduction by email. We set up a call. That's inbound. So that's Alice sharing something with us. The other way is by outbound, which is usually the more thematic firms that are doing some of this market research. And so what they'll do is they'll take a view of the world and say, in the future, I think education will look like this. And I want to invest in companies who are building that future of education. Let me go research and reach out to every startup that's in education and speak with those founders and try to find ones that fit my view of the world and what I think will happen in the future. So for us at Valia, the large majority of our deals are inbound, 70, 80%, 20, 30% are outbound, where we're reaching out. So we'll go through the example of Alice makes an introduction to us, what happens from there. So Alice shares a pitch deck, makes the email introduction. We set up a call with the founder. We'll always take either 30 minutes, 45 minutes as an intro call just to get to know them a bit. And so in that opportunity, we're learning more about the team, we're learning more about the product, the market, competition, what their traction is, what their fundraising plans are. And we're using all of those data points to calibrate if it's a good fit for our fund. In many cases, a company will stop right there in the process. They might not be a fit for the fund for whatever reason. For the much smaller number of companies that move on to the second meeting becomes a much more detailed, in-depth due diligence meeting. And so in that meeting, we're going into more detail about what their product roadmap looks like, what the customer feedback has been, digging into financials in more detail, hearing more about the team bios and beginning to do references. And that second meeting, the full due diligence meeting, becomes our chance to get our arms around the business and really get to understand it. From there, the third and fourth and the extreme cases, fifth meeting becomes surrounding our due diligence with any missing pieces. And so maybe we weren't really clear in that second meeting around what they want to do with the product at a certain point. That third meeting is a chance to understand that a bit better. And by the time we're on our fourth or fifth meeting, that's when we're ready to make a decision. And so in the meantime, what we're doing is building out our own internal memo, and that memo can be 20 pages, 30 pages, 40 pages. It encapsulates all of the information about this company and our research in one place. And so from the first meeting to the second meeting to the third meeting, we continue to build out that memo. We get ready to present it to our team. And once we present it to our team, it becomes a decision that the firm has to make whether or not they'll invest in that company or they'll pass. And so for the entrepreneur, what that looks like is first, quick meeting, calibrate, is it a fit, is it not? Several subsequent due diligence meetings, reference calls, data rooms, et cetera. And then we get to a decision. That decision then turns into legal documents, sending wires and actually closing an investment. So that's our process. It's pretty typical of most seed funds. I've heard from entrepreneurs in the region that can take a very long time in the Middle East, unfortunately. For us, we normally go from first meeting to closing a deal in 2 or 3 weeks. And that's actually not incredibly fast by US standards. There are some firms that do that in 1 week. And so the biggest difference here is there's a lot of competition for capital. And so if Alice makes the introduction to us, but also makes the introduction to another firm, if that other firm moves faster than us, then we'll lose the chance to invest in that company. And so if we take 3 months to make a decision, for example, that founder may have already raised capital and been well on their way. So we've had to develop our due diligence process to make sure it fits into the ecosystem here, which, like I said, I've heard is much slower in the Middle East.
That's amazing. That's very thorough. Thank you. So Just to clarify about Valia, sort of, can you talk a little bit about your LPs and sort of what your thesis is beyond sort of seed stage?
Yeah, for sure. So we, like Alice mentioned, we actually have the large majority of our LPs who are in the MENA region and in Europe. And so the firm actually started out in the very early days as an angel group. And so the angel group was family offices in the region who wanted to start investing in really interesting and exciting companies in the US. And myself and my partner joined when this was an angel group and helped transition that into a venture fund. And so the very early days, think MENA-based family offices, European family offices who wanted to invest in startups in the US and in Europe. And so what we did was then transition that into our first fund, which we raised in the summer of 2018. We raised a fund to just focus on pre-seed investing. And then from there, we ended up investing in a little over 20 companies, some of whom did very well. And that helped set us up to raise our second fund, which we closed over the fall. And so today we're investing out of two funds, one a much smaller pre-seed fund, the second a larger $30 million seed fund. And so both funds have a bit of overlap, but one is a little bit more pre-seed focused and the other is more seed focused. And so think pre-seed a little bit earlier, seed a little more developed. For us, in terms of thesis, we're generalists. So if you go back to that framework, we would fit into the stage focused but sector agnostic bucket of those four categories I showed. And so we invest in both consumer and enterprise focused companies. We have a few deep tech companies. And really, first and foremost, we're looking to work with outstanding founders. And so when we're looking at companies at the pre-seed, we take more of a people bet, knowing that the product will iterate and the product will evolve. And sometimes they might not even have a product. And so we know as long as it's a big enough market and it has some of the right characteristics, and if we think it's the right team, then we're willing to invest. Because the challenge at that stage is it's very risky and many of these companies do not make it. And so we'll invest in one fund closer to 30 companies. And like we saw in that math, we need one, maybe two really big outcomes. And so we have a slightly wider portfolio compared to a fund that might only invest in 10 companies, because each of those 10 companies has a lot more pressure to succeed. But we're also more focused than someone like a 500 startups. It's in their name, right? They invest in several hundred companies per fund. And so they're willing to take even more risk because they have an even wider basket of companies. And so for us today, we're investing out of those two funds, talked a little bit about the origin story, and we mostly invest in the US, but also look at opportunities globally.
Cool, thank you. So if I could summarize that just really quickly because we have a lot of entrepreneurs on the call, kind of what I heard you say was sort of the earlier seed stage, there's much more focus on founders, and as it gets later, of course, founders always matter, but then you start thinking a little bit more about traction and the product and the market.
Yeah, you're spot on. And we had done, oh, sorry, I can't share screen, but there was a presentation we did last year at our annual meeting, which had to do with what is important at what stage. And you're spot on, Pat. At the earliest stage, it's overwhelmingly a team bet. It's who are these people? What have they done in the past? What is their skill set? How do they work together? And if we're making the right investment decision at that point, we hope they can then create a product, get to product market fit, and then grow. If you're a growth stage investor, and so think about the people writing $20 million checks or $50 million checks, it almost all comes down to traction in the market at that point, because the company's already been very successful. And so clearly the people and the founders have done a phenomenal job to get the company to that stage, but they're coming in at that new point in time. So they still need to assume there's a growth opportunity ahead. Whereas we as seed investors at that point in time might be phenomenally successful already. They might have already grown 10, 20, 50x from where we invested. And so for us as early stage investors, very much a team focused investment. As you go further along, traction in the market become incredibly important.
Cool. I'm gonna double up the questions again because I am running out of time, unfortunately, and we want to leave time for the audience to ask. So I'm gonna put you on the spot a little bit. We saw the map. There was no Iraq. So I want to get your impression or your sort of prediction on what it would take for either regional VCs to enter into Iraq or for it to be organic? And then secondly, since we do have so many entrepreneurs on the call, thinking out 2 years or 3 years when we get VC, could you just very specifically, from your perspective, talk about the pros and the cons of, the pluses and the minuses of actually getting an investment sometime in the future from a venture capitalist?
Great question. So on the first one, I think the most important piece here is thinking about building an ecosystem. And I think that's where it's really exciting to see, 51 Labs as one ingredient in that ecosystem. When you look at any successful ecosystem, whether it's in the Middle East and point to the UAE or point to another part of the world, I think what's key is you have multiple stakeholders at that table who are all supporting this goal of growing the number of startups, helping those startups succeed, reducing friction, providing capital. There are so many layers to build a successful company. You need the right people, you need education, you need government support, you need capital, you need customers. You need all of these people around the table to support a company. And so I think the way to create an ecosystem in a place like Iraq is not to just focus on one of those ingredients, like capital. Capital is a very important one. But if, for example, it's too difficult to create a company and actually create an entity and manage that entity, then you're adding too much regulatory burden. If there's not enough engineers coming out of the universities, then you can't grow those teams. If there's not customers in larger companies or government who will work and provide capital in terms of revenue dollars to those companies, then how do they grow? So you really need all of these pieces. And I think that's where you really need to find people who are driven to find all of those key constituents and bring them together. And so when we look at the one capital piece and just focus on how do we get venture investors there, venture investors, I think of as one of the last steps of that puzzle. So once we have all these other people at the table, then it's very natural to bring capital to this equation. Because what capital, for the most part, what capital is trying to do is generate a return. And if they're investing in a company before that ecosystem is created, it's much harder to generate a return. And assuming that dollar can go anywhere in the world, it becomes a harder pitch to why to invest there. Once that ecosystem is created and those companies are becoming very successful and those founders are growing companies and thriving, the dollars naturally follow. So I would think of the venture dollar in particular as one of the last pieces of that equation. But once you focus on all those other pieces of the equation, it's very natural for the venture dollar to follow, because at the end of the day, we're looking for opportunities that other people are not seeing. We're looking for arbitrage. We're looking for great founders that are undiscovered. There are venture funds, for example, to just nail this home. There are venture funds leaving the Bay Area, leaving California because there's too much money here. And so what they're doing is trying to go find the next place of opportunity. So the same way I would answer this about regional firms, you can think about this internationally. If in 2 years, 5 years, you can make an argument that this is the right ecosystem to invest in, and here's why, and here's that success story, more dollars will follow. I can tell you, after the Cream acquisition, many US-focused firms said all of a sudden, oh, I want to learn about startups in the Middle East. And it was just because of that one big exit. So don't discount how important success stories are. Once they're created, it's much easier to get more dollars to follow. It's much harder to get that first dollar into the ecosystem. So that's how I would answer the first question. And then on the second, for the founders in particular, what are the pros and cons? I think on the pro bucket, it can provide access to capital to help you grow faster. That's really the goal of venture funding, is you've found something that works, or you're building something that's working, and more dollars can help you grow. Maybe it's more dollars to invest in product and team and marketing and acquisitions, whatever it might be. If your trajectory was going to be going like this, and then venture dollars can help you go like this, that's really the goal. That's when it's a fit. When you're finding something that works, that's growing into a large market, a product with product market fit, the venture dollars should help you grow faster. And in terms of pros, like that's really the main reason, because there are other sources of financing. Obviously, you can get access to great people, hopefully expands your network, but the dollars themselves, what it should be doing is helping you grow faster and providing some additional resources to help you do that. The cons list is long. So, I'll start with a couple. The first and foremost time I see it, especially in the Middle East, is when it's a con, is when they're venture capital investors who don't have a lot of experience, and they become a burden to that business rather than a boost. And it's really unfortunate because I've heard about a lot of these stories of investors who are asking for hours and hours of time every week to provide updates, and they're looking for, you know, terms that are not market. They're trying to own too much of the business. There's a lot of times when you have inexperienced venture investors who create a huge headache for a startup, and it's really unfortunate to see that. And so the first con is choosing the wrong venture investor who doesn't have a lot of experience. The second con I would point to is venture firms who are just far too aggressive on terms, and they're trying to own too much of their business, and they're trying to control the business. That's not how venture is designed. That's not how it works in the West, but I hear these stories in the Middle East. And the last con I would point to is that it is the you know, equity equation. You are giving up part of your business. And so if you don't think you're going to be able to create overwhelming, you know, additional value from that 10 or 20% you're giving up, then keep more of your equity. You know, there are a lot of very successful bootstrapped businesses. These aren't always in the news, but you can build multi-billion-dollar businesses without venture funding, and you should really think deeply about what type of financing is a good fit. And it's not always going to be venture. So those are a couple of the cons, and hopefully, you know, less pros, because like I said, I don't want everyone to think this is perfect for every business.
Yeah, that's really fair. I appreciate the transparency there on sort of both sides of the equation. I am out of time, but I'm going to put something in the back of your head in case you have the opportunity to answer this naturally as it comes up. But I think we might have some people that are interested in this as a future career. So if there's an opportunity to talk a little bit about skills and abilities and knowledge that would make a good venture capital associate or analyst, you know, somebody at the junior level, I'd love for you to be able to touch on that. But yeah. I will turn it over to our audience because they're probably tired of me. So just keep that in your mind. Alice, how do you want to go here?
So before we turn off the Facebook Live, we do have, I think, 1 or 2 questions from Facebook that we wanted to ask first. Then we're going to turn off the Facebook Live so that everybody can feel comfortable asking. So the first question from Facebook is, how can venture capital investors work around Iraq's environment, especially including the security and rule of law? So Riley, I don't know if you have specific thoughts on that.
Yeah, I don't want to give a bad answer, send people in the wrong direction. So I'll hold off on that one. But I will say that the second part of that question, I think, really gets to the heart of that ecosystem approach I was talking about. So, you know, government and regulation is one piece. It's one seat at that table. And so addressing that and making sure it's startup friendly, and, you know, whatever initiatives, I'm sure there's things happening now. Those are the types of things to support, because it's so hard to start a company. It's so hard to be a founder that you don't want to add additional red tape and regulatory burden. So I don't have any good specifics to share, but you know, overall, it's definitely something to be conscious of.
Great. There was one more quick question from Facebook, and then we're going to turn off Facebook Live. It's, what role should government play in startups and venture capital?
Yeah, I think over time, less and less, but at the earliest days, and I think there are some successful examples of this, especially in the region, government can do government can play a major role in seeding that ecosystem and starting that ecosystem. And so the way I look at it is, early on, sometimes you might not be able to get those venture dollars, you might not be able to get other dollars, but if you can get government support, that can lay the groundwork to create a successful ecosystem. And then over time, the goal is the government should take a further and further step back, because it becomes more of an open market where there's a lot of different types of capital, there's a lot of successful companies. But sometimes in the earliest days, you really need government support to kickstart that. And you can look at plenty of examples across the region where they've done this, where they provided support either to banks or directly to startups, or even, you know, Alice, where we were in Jordan, the fund of funds that they created there. There's a lot of different ways government can kickstart an ecosystem. And so I think if it's not naturally there, or it's not growing as fast as it should be, government can play a very big role if they do it right. And then over time, the idea is, you know, more and more dollars would flow into the ecosystem, and it wouldn't be as required over the long term.
Great, thank you so much. To everyone watching on Facebook, thank you so much for joining us. We hope you had fun, and we will share the broader recording later. To those of you still on this call, I know, Leilon, you had written a question in the chat box. Would you like to say the question out loud? And what I would ask of everyone on the call is please introduce yourselves before asking the question. And if you're willing to share your video, I think it makes it a lot more personal. So Leilon, we'll start with you. Let me know if you want me to read it or if you want to ask the question.
Hello, it's a bit loud here on my side because of my little one.
We can hear you.
Very good. Hello, everyone. Thank you so much, Riley, for the great presentation. It makes a lot of sense with a very simple language. Just quickly, I'm a founder of Dada Babysitting. It's an online platform for connecting parents with local babysitters to be at the parents' house for a temporary time. My question is that for an engineer to learn about venture capital, or what kind of things that they need to know before approaching an investor, a VC investor, and what are the key things that VC need to know about the entrepreneur before to make a deal with them? And what kind of commitment usually it's between the VC? How does it look like, that type of commitment between the VC investor and the startup? Thank you.
Great question. And fortunately for the business you're starting, there's a very successful example of that in the US. There's a few very successful examples. So hopefully you're getting people excited about what you're doing. I just dropped a couple links in the chat. So the very first one, in terms of learning more about venture, and at least from the founder perspective, making sure they have that base knowledge, the best one to start with is Venture Deals. It's written by a very successful venture investor based in the US. And what I love is it has both the kind of shallow intro version to make sure you know enough to understand the conversation and follow the language, but you can also go a lot deeper if you so choose. And so the best book, and it's a pretty quick read, and there's also online courses for Venture Deals. And so I think it's on Coursera, where you can take a 8 video course on Venture Deals if you prefer that format over reading. But definitely one of the best ways to learn the language behind the industry, what to look for, what not to look for, how deals work. All of that stuff is really packed into one book. So great place to start. And then the second one, which is very prominent, is a book called 0 to 1. 0 to 1 is a little bit more about the entrepreneurial journey, but I think ties into Venture Deals in the sense that it allows you to understand what the normal steps are in a startup, what investors are looking for, and puts you a bit in the investor mindset. Whereas Venture Deals is a little bit more of the general knowledge base that you would need to walk into that conversation with the right information and with a framework to help you make good decisions. The second piece of your question, like what to look for in a venture investor or what they look for in you, I think what to look for in a venture investor, I would never discount culture fit. So make sure these are people that you'd want to spend time with. Our founders, we spend a lot of time with, and we think of these as marriages. Frequently we're investing and we're part of the business for 7 to 10 years. And so it's really important for founders to do due diligence on the investors, the same way investors do due diligence on the founders. And if there's ever an investor who has an issue with that, that's a major red flag, because it's a two-way relationship. And that's one of my comments earlier about finding the right investor, is make sure they're people who want to support the company, want to support you, want to support your growth. And if you get any indication that that's not the case, it's a big red flag. And so in terms of what to look for an investor, make sure it's someone you want to learn from, you want to spend time with, you've gotten good references from other founders, and it's a critical step that I think not enough founders do. And then on the second piece, what do investors look for in founders? All sorts of different things, but I'll tell you the really simple answer, which some investors do look for. They look for founders that have had prior signs of success. And so if we'll look at the Kareem example, Kareem was a very successful exit, big outcome, multi-billion dollars. There are 50 people who are at the top of that organization who are now starting companies who venture investors are almost writing a blank check to. Because what they've done is they've gone and built up experience at other companies, or they've built a successful company in the past. And the investor is saying, oh, okay, well, they were successful in the past. That might be a good bet to take in the future. And so it doesn't always work, but anything you can show as signs of success, whether it's academic track records or prior jobs or things you've accomplished as an entrepreneur, always help the investor show that you really are someone who can accomplish certain goals, who can execute, and show that you're someone that they should be worth, making that investment on, because investors have a lot of options. Founders are choosing one decision. They're working on that one business. And so sometimes what's hard to communicate is the investor might like the company, they might think it's a good company, but it might not be the best one that they saw that month. So there are a lot of times where investors don't invest. It doesn't mean anything is wrong with the business. It just means that they have alternatives and they prefer to go with one of those alternatives.
Thank you so much. Mohammed, would you like to ask your question? Is Mohammed still on the call? Ooh, I think he dropped off. He might have had an internet problem. Well then, we are going to open it up to everyone here on the call. If you have any questions about investment or Riley or Valia Ventures or venture capital, please ask it now. And please also introduce yourself before the question. And feel free also to put it in the chat box if you are not comfortable saying it out loud.
And while we wait, I can answer your question quickly, Pat, in terms of getting into the industry. If you're interested in being an early stage investor, one of the best things you can do is work at a startup or start a startup, because what you're going to be then doing is helping another founder through that process. And so you're sharing that experience that you've already been through. And so my own background, I started a company right after college. It did not turn into cream or a big success story, but I learned a lot through that process. And I've been an investor now for the last 9 years. And so for early stage investors, startup experience is incredibly helpful, or working at other software companies. If you want to be a later stage investor and you want to invest in very large, already successful companies, the financial background is a lot more relevant. So you'll see a lot of people coming from banking or coming from finance. They probably have studied finance or economics in the past. And so the later stage investors think much more quantitative, much more numbers driven. It's good to have that as a foundation of your career. If you want to be an early stage investor, it's a lot more qualitative, and sharing relevant experience as an existing founder or as a co-founder or as an early employee is usually one of the best places to go to build that experience.
Great, thank you. I think Mohammed is back. Mohammed, do you want to ask your question now?
Yeah, sure. First of all, I want to thank Mr. Riley for being here. And I'm an entrepreneur and founder. I'm the CEO of Thematic Ventures, and also I am a business advisor with Iraq Responsive Labs. And it's very refreshing to hear you, because we are also planning to start a VC in Kurdistan region.
Great.
And it was very refreshing to hear all the information from you. And I have some information, some questions actually. I would be happy if you could answer me. First of all, the 2 and 20s, that's how we call it in the Valley. So the 20%, which is the carry, is it also the same thing when you get monthly profits? So let's say that startup is also yielding profit. Is it the same thing? You get 20% of the profits as the VC, as the general partners? That's my first question. The second question, is it necessary for the VC to invest in millions? Maybe we invest 200,000, 300,000. Is that all right? And my third question is support. One of our ideas to start our VC fund is to provide all kind of financial, marketing, sales support. So since the entrepreneurs are not fully grown, the atmosphere and the place is not quite ready, that's part of our plan to provide full support. I want your take on that. And my last question is, part of a VC is the general partners have to also put some money into it. Let's say we have a deal to put $1 million. I think you have to put 10% down as well as general partners. Is that a rule? And the 2 and 20s and everything here, can we, since we are going to be the first VC fund in the Iraq region, as my information, can we play with that? Can we make the 2-5? What's the consequences of that? And general tips from you will be very interesting to hear. Thank you.
Yeah, I appreciate the question, and it's specific. I'll answer it, but I think it will probably be helpful for everyone, and also happy to chat offline and after this as well if it's helpful. First piece on profits, that's quite rare. So what's much more normal is you take every single dollar of profit and invest it back into growth. So let's assume we could make a distribution one year and pay out all the shareholders. What we'd rather do is invest and keep growing. And so the goal would be to grow the company as large as possible. And then if it gets to a stage of wanting to make distributions, then that might happen. But usually think, 5 years out, 7 years out, far away into the future. And at that point, you wouldn't be taking the profit on that, because those distributions would be going back to the fund. You have to repay the full fund commitment. And so it would take a while for those distributions to turn into carry dollars. Second question on check size, you can definitely write six-figure checks. We actually sometimes write as little as $100,000. Other funds write $50,000 checks. And so you can write $100,000 checks, $200,000 checks, it's completely fine. It's more based off your fund size. And so what's normal is to invest 1 to 3% of your fund. And so if that's a $10 million fund, think $100,000 to $300,000. If that's a $100 million fund, that's $1 to $3 million. And so depending on your fund size, very normal to write six-figure checks or even five-figure checks. The support question I love. I think every good investor should support their companies and find ways to support the ecosystem. So that's definitely something you should be doing. And whether it's with hiring or with product or marketing or finding customers or fundraising, there's all sorts of things you can do as an investor to support your companies. And it's definitely something you should do and something that I think will help set a good example for the region and the country. And then the last piece on the GP commit, what's typical is to commit 1% of the fund. So that's very standard in the West. So if it's a $10 million fund, the GP would commit $100,000. If it's a $100 million fund, the GPs collectively would commit $1 million. A really important distinction here is you don't need to put that upfront in cash on day one. It's usually through capital commitments and capital calls. And so let's say you're raising a $10 million fund, you want to commit $100,000. That $100,000 is spread between you and all of your partners. And it also might be over a 3 to 5 year period. And so it's like, can you contribute $10,000 or $20,000 and can a couple of your partners do that? If that's the case, then you can satisfy that 1% commit. And that's the standard, that's the bar. And there are also some times where people don't contribute that. It's quite rare, but think 1% instead of 10% as the standard.
Thank you so much. It was very informative. Thank you. And I'll be happy if you could contact after this as well.
Of course, happy to.
I am happy to connect you guys offline, and Riley, if you're willing to share your details, or we can share your LinkedIn so that people can be in touch with you there as well. We are now after 8 p.m. Iraq time. Oh, great. So Riley just shared his email address over the chat so that you all have access to it, which is very nice of you, Riley.
Of course.
We are officially over time. Riley, I'm guessing you have to go to your job and other things. The rest of us have to go to our evening activities. To all of the people that attended today, thank you all so much. It was great having you here and great to see so many of our entrepreneurs and community here. Riley, thank you so much for joining us. This was very informative and very clear, and I think you were great at answering all of the questions. So we really appreciated having you here, and I think this video also is going to be a really great resource for entrepreneurs in the future. And hopefully we can have you come out and visit us in Iraq at some point.
Yeah, whenever the world starts to travel again, we can definitely look into that. Yeah, thank you so much for having me. Really enjoyed the conversation, and like I said, a huge fan of what you're doing. I think it's so important, and any chance I have to support the organization, I'm happy to. So please reach out if people have any questions. Always happy to answer things by email or jump on a quick call. And hopefully this was helpful and informative for everyone.
Great. Thank you so much. Everybody will send out the video afterwards also, so you have it as a resource. And have a good night, everybody. Have a good day, Riley. And we will talk to you all soon, hopefully.
Thank you, Riley.
That's good. Thank you, everyone. Take care.
Bye. Bye, everybody.